Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, January 26th, and then we'll see how things look for Friday, January 27th. We had another up day. A lot of people are really convinced that the market was going to go down, and so what does it do? Goes up. Well, we might be getting close to the point where we're starting to bump into some things that may provide a bit more resistance than what we've been seeing. Even though we're already dealing with resistance, there are some other factors starting to come in. We don't really know if they'll play out in Friday's session, but we just want to keep a close eye on these things. I explain all of that in the video, and hopefully you'll find this very insightful. Let's go back and talk about what happened. Right at the open, we had a gap higher open. The futures were pretty strong during the night, and then the economic reports came out. That bumped up things to provide a more positive open. We opened above R1 at 40.41. Isn't that interesting? That's one of the resistance levels that we've been trying to bump into. We actually opened above that. Now, we would fall down below that, and it would kind of provide some resistance as we're going back up. It's not necessarily happenstance when we start hitting these levels that we see in front of us well before we even get there. After we got above R1, prices chopped much lower to go down to the unchanged level. We could say that was a filling of the gap. We came all the way down to the unchanged level. That acted as support, and then we bounced up from there. As the day went on, prices spent the rest of the day climbing back through R1, but never reached R2 at 40.65. There was probably some panic short covering going on as we were getting closer to the close that pushed prices just a little higher, and we ended up closing right at the high. We were up 1.1%. Volume was above average. We're not seeing a real breakout in volume, and that's a little bit of a concern. That's something that I'm kind of looking at. I have a chart to show you. The fact that we're going up and volume is not really starting to advance is a little bit concerning. The technicals were positive now, but we're starting to get extended to the upside. Short term, we're looking overbought. Intermediate term, we're starting to see a more overbought condition. Plus, we're getting ready to be either at or near some overhead resistance that I will point out to you. Inflation and interest rates, that's the story because it's producing growth concerns both internally in the U.S. and worldwide. Earnings per share, valuation concerns, figuring that the stock market is a little overvalued right now or expensive. Now we have geopolitical concerns. I highlighted that one back in gold again. Germany and the U.S. are sending tanks into Ukraine. That could be seen as an escalation, and that could feed over into things getting a lot hotter, at least for America. They're already hot in Ukraine. That could eventually come through and have some impact on the stock market. Any Fed speak that we might get, and then they still haven't dealt with this issue concerning the debt ceiling. Here is the intraday chart where we gapped up. We were able to get right above R1 right at the open, and then we came down. We chopped our way lower. It looked like we were going to try to go up a little sooner than we did. No, that wasn't really happening. We came down to the unchanged level, even went negative a little bit here. Then after this base was set, we spent the rest of the day going up. So if you look at Wednesday's chart where we gapped lower, came down, we set this low at 39.50, and then we saw the rest of the day really advance. Well, we kind of picked up here. We gapped up, came down, and then we just kept going only to close at the high. For 2 days, we saw one day was a recovery, and then the next day was gains. So that's fairly positive. Let's go back and talk about what happened. The rally resumed since the recovery on Wednesday. Now, it could stop at any time, but at least in Thursday's session, we did see some advancing. This was likely influenced by short covering. Those folks sell to get in and then have to buy to get out. When you have a whole lot of people doing that at the same time, that can really push prices up. And also FOMO, the fear of missing out. Everybody was completely convinced that the market's going down. Well, it's been going up. Now, it could ultimately go down. We're just talking about right now. You have a lot of people that are pretty confused right now, or they're reacting to what's already happening. And so they start jumping in without realizing that we may be getting to the point where in the short term anyway, we are exhausting ourselves. And I'll go through and show that to you. But we have to ask the question, can it continue? Can we keep going up from here? Just because we're at these levels that may be providing some overhead resistance doesn't mean we have to stop. We could plow through those, and that would turn things even more positive. We have kind of overdone it, especially when we're in a trendless environment. We shoot up the way we have in the last couple of days. That's going to throw us into an overbought condition pretty quickly. The advanced GDP report, durable goods, jobless claims, Tesla earnings, those came in and everybody was happy, and it was party time. IBM came out with their earnings, and it wasn't really well received. In fact, they really dragged the Dow down. And then Chevron, they announced that they're going to be doing a buyback, just a massive buyback. The earnings for Chevron will come out in Friday's session. When we were pulling back right after the open, this whole friendly or dovish scenario, it's like, wait a minute, GDP was better than we thought, durable goods came in better, jobless claims are going down, Tesla's doing really good. Maybe we should not be as happy about things because our dovish scenario is in doubt. Germany and the U.S. have agreed to supply tanks to Ukraine, and then this is producing fears of escalation. Small caps and mid caps, they did pretty well, but growth only slightly outperformed value. That's a little bit of a warning sign. We're seeing growth doing pretty good with the large caps, with the S&P 500. We're not seeing it really carry through to the mid caps and small caps, and that's concern number one. Remember, when we're going up, I look for things that are negative. When we're going down, I tend to look for things that are positive. I'm finding some negative things that I feel that you should know. Another concern that I'm seeing, number two, is the new highs are not advancing. We're starting to break out based on price, and we're not seeing the new highs breaking out at this point. It could improve, and I'll go through the chart and show you that, but you would think that these would be picking up a little more than they are. Home builders are starting to show a negative divergence, and I'll show you the chart of that. So that's warning sign number three. Volume is not expanding as prices climb. That's also a concern. On a short-term basis, we still have our Stoke RSI, our Williams percent R. Those are the usual suspects that are extreme positive. And in the intermediate term, we're having the Sean Trend Meter, or CTM. That's looking pretty extreme. And the CCI 14 and 20, not really big ones, and they could still go further from here, but just be aware of those things. On the long-term basis, we're still looking at our moving average study. That hasn't changed. The 150-period moving average is looking extreme. The dollar was up, and interest rates were also up. Copper, which I don't have a chart to show you today because I have some other charts that I want to go through, it's still holding on to its gains. And we still have the 10 to the 5, the 10 to the 2, the 10 to the 3 month. Those yield curves remain inverted. Sentiment is positive. We're just getting into that extreme positive area, but we're not there yet. We're giving a current reading of 69. Then the economic reports, there was a whole list of them that came out, and so I just did another slide to go over those things. Our trend is positive and getting stronger. We're still above the moving average. It's not really turning up with a lot of conviction, but it's above the moving average. However, we're still below 20. I'm keeping our bias at positive because we had another update, and our momentum is now positive as well. Here's some of the economic reports that came out. This was the big one. This is fourth quarter GDP, the advanced reading. We get like 4 readings until this thing's finally done. It came in at 2.9%. That's positive. That's not recessionary. If it's negative, then it would be indicating that we're either in the beginning or in the middle of a recession. They expected it to come in at 2.6%. So that was better than expected. And that gave some hope. Thursday seemed to be the day where good news was good news. Now, if this good news keeps on going, it's going to freak the markets out. We have some big reports coming out on Friday, so we'll see. The last time we had GDP, it came in at 3.2%. So it has declined, but it's still positive. And then you have the chain deflator. That came in at 3.5%, more than the 3.2%. Another measure of inflation, but it is coming down from the 4.4% that we saw last time. Durable goods. These are big ticket items that companies buy. Came in at 5.6%, well above the 2.9% that they had expected. The last time it was down 1.7%. If you take out transportation, it was down 0.1%. Not as much as the down 0.2% that they had expected. The last time we had this report, it was up 0.1%. Jobless claims continue to fall. They came in at 186,000 versus the 205,000 that was expected, and also lower than the 192,000 that we saw last week. Advanced international trade in goods came in at minus $88.3 billion, more than the minus $82.9 billion that we saw last time. Retail inventories up 0.5%, where last time they were unchanged. Wholesale inventories were up 0.1%, where the last time they were up 0.9%. And new home sales came in at 616,000, about where they had been expected at 614,000 and above the 602,000 that we saw last time. One headline that I did come across that I got from Reuters says that Ukraine faces deadly Russian missile onslaught after securing tanks from allies. Those allies are Germany and the U.S. Just think about it. If you were Putin, whether you love him or hate him or you think he's good or evil, if one of their allies starts sending tanks over to somebody that you're fighting, would you do anything different at that point? Probably so. Another thing that I got from Twitter, and I try not to get hung up on Twitter, I just kind of glance through it from time to time. I seem to like this Michael J. Kramer. I found that about 99.8% of everything on Twitter is completely useless. I don't really care about people's opinions. I don't really care about the new cars that are coming out in a few months. I don't care about a clothing line, all the stuff that usually gets reported, even in the financial areas of Twitter. This person, even though some of his charts, I'm kind of like, where did you get that? Some of his charts tend to be rather insightful. And he posted this one. I think he has a Bloomberg terminal, so he gets access to a lot of different charts. I can't justify the cost at that. Last time I checked, it was like $2,000 a month to get Bloomberg terminal. These are the reserve balances held by the Fed, dropped this week to $3 trillion. Just a measly $3 trillion. Good luck. The interesting thing that I saw here is look at the black line, which this is the reserve balance, and look at the blue line. That's the S&P 500. When it's going up, the S&P has a tendency to go up. When it's going down, the S&P has a tendency to go down. Look at where we're at right now. The S&P is going up and the reserve balance is going down. That could produce some short-term stress on the markets. That's another warning sign. I forget where we're at. Is that number 5 now? Another thing to be aware of, this is more informational. And this is somebody that I just started following on Twitter, Markets and Mayhem. That's a pretty good handle to have. It says hedge funds are now net long stocks for the first time since the first half of 2022. I would not necessarily take this as good news. As I teach in my classes, hedge funds, they might be big money, but they're not necessarily smart money. And so just because hedge funds are doing something and we might see them as things are happening, doesn't mean we need to follow them. It's the institutions. It's the true smart money that we need to follow, and hedge funds typically don't fall into that category. This is the same writer that put that balloon out back in 2022 that the markets thought, oh great, the Fed's going to pivot. And then earlier this week, he had another article that I thought was kind of interesting. This is based on the St. Louis Fed research. This just says that the stimulus that was pumped in to the economy, because everyone's saying, we can't put all this stimulus into the economy. It's going to cause inflation. Well, back it up with some numbers. Well, it says here that the stimulus, it contributed to excess inflation of about 2.6%. So the inflation that we have now, 2.6% of that came from the stimulus. It's also impacting Canada as well as the UK, but I wanted to focus on it more for how it's impacting the US. All right, we got the weekly survey from individual investors. Shows that after being pretty extreme negative, they're showing some improvement. These folks tend to follow what's already happened, so we really only use this indicator when it's giving us an extreme negative or an extreme positive reading. But well, we're no longer extreme negative. Here are the jobless claims showing that the 4-week simple moving average shows how they are going down. However, the 4-week simple moving average of continuing claims is seeing a bit of a turn back up. We're right on top of the moving average. Here's our VIX to S&P 500 correlation. After spiking up, it's now coming down. Haven't had to update this lately. This little highlighted area, haven't had to change that in a couple days now. When we spike up and come down, that usually means some kind of a trend thrust in one direction or the other. Typically, it's been positive, but there are some times when it's been negative. We've been working off of this now for about a week, and we've been going up since then. So I would go with the idea that it's giving support to the market. The Ulster Index is also pretty complacent right now, but not really extreme. If we have another update, we're probably going to go extreme with our sentiment indicator. Here's the equity put call ratio on an up day. It did decline. And our 5-period simple moving average has us back to declining. We're still working off of this spike. When we spike up and come down, a lot of times that gives support to the S&P. Here's a longer term chart showing that same thing. The VIX continues to fall. We're well under 20. We're falling on the line chart. We're also falling on the bar chart, suggesting that there's not a lot of fear right now. When the VIX is low, it's time to go. This is like warning sign number 6, but we've been dealing with this now for a few days. Here's our ADX indicator showing our trend. We're above the moving average. The green line's on top, but we're below 20. So we're still in a confirmed trendless environment unless you are really aggressive with things. You probably want to see some more confirmation first. And I have another daily chart to show you. I'm looking at this, just goes back a year. The chart right after this will go back 2 years. Here's this trend line. We were able to break above that. We're getting a little further above it. That's positive. We have some other resistance that we might bump into just above current prices. We're above the 200. We're above the 50. If we stay above this for any length of time, we might actually see a golden cross. So this is looking positive right now, but we've got lots of overhead resistance where we're at right now. Looking at the bottom, we're just a little bit up over average. And here's a 2-year look at that same chart. Going back to the all-time high set in early January 2022, here's the downward sloping trend line, and just showing where some of these resistance levels came from that we might be getting ready to bump back into. I just thought a longer term look at this might provide a better perspective. Here's our Arun with the up day. We continue to show that buyers are now in full control as sellers are waning. So you look at our oscillator overall, it continues to advance. Are we getting a little toppy with this? Possibly. But there's other indicators that I like better to suggest those things. The rate of change going back 5 periods, we're starting to get extreme positive. And our stochastics looking extreme in the short, intermediate term, still looking positive in the longer term. Stoch RSI, extreme positive. Williams percent R, extreme positive. We're getting back up to what might be the underside of this anchored moving average going back to the all-time high. We're not there yet. It's at about the 40.84 level. That's about 24 points above where we're at right now. Here's the BPI. We're not seeing really much of a breakout, but that's probably because we're reading a lot of these prices where we were at not too long ago. But it's still positive overall. Just a little green tick up. We're above 50 and advancing and not extreme with this indicator. Shaken money flow showing nice improvement here and not necessarily extreme. It can go a lot higher than where it's at right now. The Sean trend meter, which I did mention, we're starting to get extreme positive with that reading. CCI 14 extreme and 20 are extreme. Here's the Chaikin oscillator, also starting to look a little toppy, getting into that area. This is a little bit of a concern. We would like to see a breakout in volume as prices seem to be breaking out, although we're hitting right into some resistance here. But the fact that we're actually declining and not seeing a real thrust with volume is a little bit concerning. Point and figure chart had a new X here, still generating a signal called a low polar reversal that was generated back on the 9th of January. This is just starting to look more positive. This chart just takes into account price movement. It does not account for time. Here's our short-term fib level, breaking above the 4006 level. We're kind of in no man's land. If we really get rip into the upside, we're looking at the 4123 level, at least in the short-term sense. If we fall, we might be able to say that 4006 could provide some support. And then our longer term fib chart, we're getting above that 4020 level. If we do fall, it might be a little too soon to really call that support. The Swinland trading oscillator based on price and volume continue to advance and they're above zero. That's positive. We're getting above all the moving averages now in our moving average tree. And the longer we do that, these other shorter moving averages will start to improve. We are positive with the Elder Impulse system after being neutral. And the McClellan oscillator is above zero, advancing, and not extreme. The summation index based on price is advancing as well as volume. Here's one of the concerns. We did see a nice little addition to the new highs, but we're not seeing a really big bar here. Now, it could be because we're in prices that we were in not so long ago, back in November and in December. It hasn't turned our 5-period simple moving average up. Now, this could be getting ready to cross, and that would certainly look better. We would like to see this advancing more than it is, and we're flat pretty much to slightly increasing with the 10-day differential. The advanced decline line based on price and volume, those are looking fairly good right now. They're positive and both are above their respective moving averages. Accumulation distribution also looking pretty good. The Copic curve gave us a buy signal in early January. That's still valid. The Pring bottom fisher also gave us a buy signal around that same time. This could be getting ready to go away. This, to me, doesn't necessarily mean that it's a sell signal. It just means this buy signal is no longer valid. Then we still work off of it based on what our other indicators are telling us. Here's the 150 simple moving average, still extreme positive. The Dow above the pivot level, above the 50 and 200-day moving average, that's positive. And here's the Elder Impulse system for the diamonds, which are still positive since they're green. This is warning number 8, I think. And then 9 will be the NASDAQ 100. We're coming right up to the 200-day moving average on the NASDAQ. NASDAQ hasn't seen this in a long time. Didn't see it at all in 2022. This could be kind of significant. We could bump into this. We might already start to be coming down from that. Just something to be aware of. However, with the NASDAQ 100, we're just a little bit above the 200-day moving average. But that may provide some overhead resistance. The Elder Impulse for the Qs, which is the ETF for the NASDAQ 100, they have switched back to positive. The mid-caps looking pretty good. Above the pivot, advancing, looking like they're breaking out after giving us a golden cross in late December. The home builders, also something to be a little concerned about. This could be warning number 9, maybe. We're seeing kind of a breakout now, and these are not trend lines. These are just to accent price action. We're starting to break out a little bit with the S&P 500. We're pretty much flat to even a little bit lower with the home builders ETF. We're seeing a little bit of a divergence here, a negative divergence, when you look at the ratio between home builders and the S&P. That's not following what we're seeing right now. And so, because they're having a tendency to not move in the same direction, this correlation is continuing to go down. That's just another warning sign that we need to be aware of. Semiconductors, getting ready to give us one of these golden crosses. Is that going to be valid? Are we going to be able to push above the 200-day moving averages in the NASDAQ and the NASDAQ 100 if the semiconductors have a good, strong day? Emerging markets continue to do better and starting to generate that golden cross. Looking at our possible positive scenarios, the Qs to the S&P looking pretty good. Discretionary to the S&P looking pretty good. Large cap growth to large cap value looking pretty good here. The concern is on these next series of charts. Large cap doing okay. But look at the mid caps. They're doing better, but they're not really breaking out. The same thing with the small caps. They're actually declining slightly. That's another warning sign. Then our small cap index, even though it's doing okay, it was up 0.69% after giving us a recent golden cross. It's still doing okay, but not breaking out the way we would like to see in a good, healthy environment. Here's the ratio. We're actually declining with this red line. It's coming down slightly. That could put some pressure on the S&P. And this is looking even more viable, where we spiked up with the staples ratio to the S&P, and now it's coming down. It's continuing to fall. And we haven't seen it fall this much in, going back to the COVID low. We saw it fall a little bit in 2022. It did decline throughout 2021, but I'm just looking at more of a straight down decline here. All right, what's our outlook then for Friday? The technicals are positive. We're above long-term resistance. I'm still calling that resistance for right now. I almost switched it until I saw some of these warning signs that I brought up to you. We're becoming short and intermediate term overbought, while the NASDAQ and NASDAQ 100 are hitting resistance that they haven't hit in a long time. We have the personal income and spending coming out, PCE price index, and the core PCE price index. That's a biggie right there. Pending home sales, also not as important, but still important. And then consumer sentiment. That could be rather important, just to see how people are feeling about things. We have the Russia-Ukraine situation with the tanks. That could escalate. Inflation and interest rates, that's the freak out of the markets, because that's feeding over into the earnings per share and the valuation concerns. Earnings will be coming out again on Friday that could have a big impact on the market. And then the debt ceiling just is not being dealt with currently. Just a lot of back and forth, finger pointing and blaming. Looking at the Stock Traders Almanac statistics for the 27th, not really all that great. The Dow's up a little more than half the time. The S&P's down more than it's up, so that's actually negative. And the NASDAQ, that's a little more positive, where it tends to be up 57.1% of the time. All these other things I go through a lot. I'll probably spend a little bit more time in the weekend videos looking at these other areas. Our scenarios. Can't really go with the down one, although we're above the trend line and we could be hitting some resistance, and we are starting to get a little bit overbought, but is it enough to really shift things back in a more negative tone? Can't really go with the positive, because even though it looks like we could be breaking out, we're getting to that short-term and slightly intermediate-term overbought condition. Our scenarios are improving. Our rotation's looking a little bit better. Our positive setups, not really working off of those, because we're not coming from an extreme negative reading to the point where we're at right now. So we're still going with the sideways to neutral trend, because the ADX is above the moving average, so it's strengthening, but it's still below 20. The green line's on top, so it's positive. Our conclusion, the S&P is positive, above the trend line, but becoming more overbought in the short and intermediate term, with the NASDAQ and NASDAQ 100 at resistance. Yes, I purposely wanted to put these things in here more than one time to wait a minute, you told us that already. Well, I want this to kind of sink in. They may become irrelevant, but we're seeing about 10 different things that are giving us some warning signs right now, just to be careful. Short term, we're positive, but becoming overbought. Same thing in the intermediate term. We are turning more positive. Every day we're above that 200-day simple moving average. That is more positive and could help the longer term picture. Thank you. Have a wonderful day on Friday. I will look at preparing the weekly video and the intermarket analysis video, as well as the deep dive video where I go over the charts that I don't really cover in the rest of the videos. So have a really great day, and I will talk to you in the next video.